Hey traders, I recently planned for a $100 loss on a trade but ended up with a $1,100 profit instead. I'll show you that here in a second, but this proved just how powerful a solid risk management plan can be. Today, we're diving into this fundamental yet often overlooked part of trading. By the end of this video, you're going to have a step-by-step blueprint for managing your risk that leads to consistent profits, even with a 50% win rate. Stick around. These tools, while not flashy, are the backbone to staying profitable, and every serious trader knows that they're key to staying in the game. Every time I enter a trade, I know two things beforehand: how much I'm risking and exactly where I'll exit if trades go against me. I'm planning my losses. Many traders get stuck into the mindset of focusing on potential profits, but in reality, if you want long-term career in trading, you need to focus on managing your losses first. Just the other day during my live stream, and if you would like to join, we're live 5 days a week starting at 9:15 and would love to have you. We were doing some trades and I took a long, and during this long I start going into this risk management assessment on what to look for, why this wasn't a good spot and why this was a good spot. This is going to be very helpful in our discussion here today. Because it's already so high, I almost prefer to wait to see it do that if it can without running these highs. Stop loss would still have to be down there. That's very large with your profit up here. I would have never taken this on a personal account like this. I'm showing why we don't do it because the drawdown can be so large. Now, if you still felt like we were bullish, this would be your entry. This would be a fantastic entry. Your risk is extremely low. You have a nice order block right here. Beautiful entry right there. When we're taking a trade, the first thing that you need to be figuring out is your risk management. If you want to be a high profile trader, this is not one of those trades you would want to get in at this point. You would want to get in lower down here where your risk is a lot less. We know that our risk would have been much greater, much larger by taking the long where we did. Now, as a high profile trader, we have a greater opportunity to see success by getting in lower, planning on a 2.5 loss with two contracts. It's just under $100. Right now, if you were to take that position from this point, you'd be up 40 handles on two contracts. That's $800. You risked $100 and you're profiting over $800 at this point right here. But when you want to say, oh, I don't want to miss the move, I don't want to miss the opportunity, so you get in long here because you saw your model, you just put yourself in a very hard spot. We had to weather 25 handles of drawdown with two contracts. That alone right there, that is $1,000. Would you rather say, you know what, let's wait for a better position and see if we get it down here? Or do we just go, oh, I don't want to miss the opportunity, I'm very bullish, I know it's gonna go up here, and then have to deal through this, potentially getting stopped out, potentially closing your trade prematurely because your emotions are getting involved and you don't want to lose any more money, so you close the trade prematurely because you didn't manage your risk appropriately. The chances of us getting stopped out here is much greater. It could just wick right here, stop us out, and then run this high. This is why we want to wait for the premium type setups. There it is. There it is, folks. 57 handles at this point, $1,100 with one contract, $100 risk for an $1,100 profit. Every trade should make sense from a risk to reward perspective. Would you risk $100 to just make $1? Probably not. But if you were risking $100 to potentially make $1,000 and have a high probability of success, that's more reasonable. You need to ask yourself, does the reward justify the risk? If not, stay away from the trade completely. So if I was to go long on this breaker, which I ended up going long, I would have set my stop loss at a standard 10 handles because that is my standard risk of $200. Well, a 1-to-1 ratio is now targeting 10 handles as well. That would be right there. Now, if I wanted to go 2-to-1 ratio, I'm looking to target 20 handles. Then if you wanted to go to 3-to-1, you would go 30 handles. For this particular trade, I actually targeted this high sitting right here. This is the liquidity point right here and that I'm referring to. If that liquidity point was right here, that liquidity point, let's just say the entry was right here and we were targeting that liquidity point right there and our stop loss was down here, that right there does not make sense. Why? Because our target for the liquidity, the buy stop sitting above this level, is only 5 handles away, but we could retrace all the way down to this breaker and turn around, and that's a 25 handle stop loss. That risk to reward just does not make sense. Now, here is the beauty to using 1-to-1, 2-to-1, and 3-to-1, especially if you are a new trader who may have not found their groove and have a high win rate yet. Maybe you're struggling and you have more losses than wins. What I'm going to share with you is going to change your view on risk management, and it's going to help you become successful and a profitable trader so much faster. Let's go ahead and let's take a look at this calculator that I have for us. Okay, for this example, let's just say we're starting out with $1,000 and we want to track what kind of return would we get over the course of 60 trades. Let's say we take one trade per day and we're only willing to risk 5% of our account. 5% of our account out of $1,000 is really low. It's only $50. So even if we only risk $50, if we go a 2-to-1 risk to reward, that means our profit would be what? It would be $100, double the amount of what our potential loss could be. Now, here's where the magic happens. Watch this when we put in this number. Let's just say you only win 40% of the time and you lose 60% of the time. When we calculate this number over the course of 60 trades, look at what your ending balance is. It's $1,554. You just made and profited $554 with only a 40% win rate. Here is what that potentially could look like. You may have a couple win streaks, but you also may have a couple losing streaks, which is very common. Here's the thing. Your reward is always double the amount that you risk. As a result, you are going to see profitability. Now, look at the magic when we change this from 40 to 50. Guys, this is amazing. We just went from $1,500 to $3,700 by increasing your win rate by only 10%, by cutting out more negative trades and introducing more winning trades. We didn't introduce more risk. We didn't increase our contracts. We did none of that. We just improved our ability. This is why it's so important that you as a trader focus on education, not profits. If you can put your focus on that education, you're going to see your win rate increase, which is going to drastically improve your profitability. Position sizing is key and should align with your account size. If you're using prop firm capital, you need to calculate what your max drawdown is. For example, if you're purchasing a 50K account from Apex, it would cost you about $33 when you use the code DTJ, which gives you 80% off. Now, that's cheap, but why would you want a 50K account over a 25K account? Well, the reason would be because the max drawdown for a 50K account is $2,500. You want that extra $2,500 because that is the risk you have to work with in a prop firm account. To determine your position size, you want to take the number of trades that you want to take before you would blow your account. So in this case, if you have $2,500 for a drawdown, and if you're comfortable, let's say with the number 10 for easy math, which is actually the number I used, that would give you $250 of risk that you're allowed to play with when you're in an individual trade. And you can do that 10 times with 10 losses before your account is blown. Let's go to the chart and let me show you a few examples. Let's go back to the example of the trade that I took earlier today. I went long on this inversion and this breaker, and I targeted this swing high sitting right here. If we're using the example of a $250 stop loss, what does that mean that we can actually do? If we're taking only one contract and we are looking to go long right here, and our max amount that we're willing to accept as a loss is $250. What does that mean we have to put our stop loss at? Well, the answer is simple. It is 12.5. Every point we go down is $20. So if we go down $10, that's $200. To get $50 more, it's 2.5 handles. And so our max stop loss would be sitting right here as an example. Let's just say we went long here, we got in late, and we see the opportunity. Our stop loss right now is not in an appropriate spot. I would want my stop loss to be below this inversion fair value gap. So if I was to put my stop below this inversion fair value gap, my stop loss now drops to 16.25 handles. My risk would be too great by doing one mini contract. I would need to adjust the amount of contracts that I would take. So in this case, I couldn't do a mini contract anymore, and I'd have to go down to the micros and take along with maybe 6 micro contracts, 7 micro contracts to adjust for the larger stop loss that I would need. We always want to think about what is the amount that I'm willing to lose, or how much could I lose in this, and accept that the moment you choose to take the trade, expecting that it could hit it, but it also could hit the other way, and we just leave our hands off and we let the trade play out. A key mistake traders make is moving or ignoring their stops. If you plan to risk $250 but end up moving and losing $1,000 because you didn't stick to your stop loss, you're literally setting yourself for inconsistent results. Following your stops not only keep your losses small, but also gives you a consistent framework for evaluating trade outcomes. What do I mean by this? Basically, what I'm saying is you want to see consistency in your trading, not only in your targets, but also your stops. If you want to see if a model that you're trying out or a model somebody else is recommending you is actually effective, you moving your stops are going to hurt you in the long run, and you will not be able to get consistent results as a result of it. There are so many different ways that you can look at risk management. What matters is what makes you comfortable and what you can stick with. Now, if you got value out of this video, give it a thumbs up and subscribe to the channel. If you like this video, then check out this video here where I help you recognize reversals with one of my favorite entry models, the breaker. If you haven't seen it, you can check that out here. Thanks for watching, guys. We'll see you in the next one. Take care.